Well, hi everyone, Shaun Humphries here with Assante Capital Management. Welcome to this installment of our video series dealing with the topic of investment planning. In this particular video, we're going to talk about income and liquidity during times of market volatility. And so I'd say one of the biggest concerns that people have around their investment portfolios, particularly for those people who are getting close to retirement or are retired, is making sure their portfolio can deal with market volatility. So what is often the case is that many investors in retirement cannot afford to put all of their capital in guaranteed investments, whether that be guaranteed bonds, T-bills, term deposits, guaranteed investment certificates. The after-tax, after-inflation returns are just too low to put all their portfolio value in those investments. And as a consequence, they have money in the market. They have money in high-quality stocks, ETFs, various investments that are designed to deliver above-average returns over time to them, but do expose them to short-term fluctuation in capital markets. So it always brings up the question, how do we defend portfolios against that volatility, particularly when no one has a crystal ball to accurately forecast when that volatility might hit? So we're going to talk about a strategy, a very simple strategy, but a very effective strategy for dealing with market volatility. So if you are getting close to retirement or you're retired now, you'll find this particular strategy, although it's simple, a very effective way of protecting you against market volatility. So let's take a look at the strategy. So pivotal to this whole discussion is retirement cash flow planning. In other words, what we need to do is take a very precise look at our retirement cash flows. So over the next few years, really dialing into what will you need to be delivered to you to fund your after-tax income over the next 1, 2, 3, 4, 5 years if you're already retired. Or if you're not yet retired, when will that begin happening? Is it 3 years away? Is it 4 years away? Is it 5 years away? And you need to begin getting your portfolio positioned to fund those particular expenses that are coming up. So retirement cash flow forecasting is absolutely critical to this discussion. So this particular chart you see in front of you is a sample graph from the financial forecasting software that we have in our office. And you can see this particular client had a need of, let's say, roughly $80,000 a year of after-tax income. That's the green line here. And you can see the green line is going up at roughly 2.5% inflation every single year. And that income need goes up significantly from, let's say, $80,000 after tax to $180,000 after tax over that time frame. Now, what we see is that the client is able to fully fund all of their income requirements. There's no shortfalls or deficits. Money was coming from, Canada Pension Plan, Old Age Security, some RIF payments, some company pension income, and then the turquoise or bluish color was tax-paid money coming out of the non-registered portfolio to fund expenses. Now, this is a little harder to see, but what this chart is from the same analysis, and it begins to show us what was coming out of the account over the years to fund income. And you can see that the client had some pension income, some government benefits here. So specifically in year 3, they had government benefits of just over $10,000. They had pensions of about $18,000 roughly. They had RSP income of just under $6,000. And they had other non-taxable investment income, or interest income, coming out of the portfolio. And you could see every single year they were pulling out money from their portfolio. And it was averaging close to $20,000 a year. So when we did this analysis, we could look at the spreadsheets and know very precisely how much was being pulled from the portfolio. That's the first bit of homework that we have to undertake before we talk about the income wedge strategy. So what are the cash flow requirements? When do they begin happening? What are the dollar amounts? And then once we know those amounts, then we begin building the wedge strategy. And in a very simple way, the wedge strategy is, if you look at your overall portfolio, which is this circle, which is a balanced or growth portfolio, the wedge is in the red here, and this is money that's been set aside to deliver income to the client over the next 3, 4, 5 years. And the money that's invested there is hyper-conservative. So it's money that's not really attached to the market volatility. The client puts into the portfolio what they need to generate the income they require. And so when you look at this, this asset, it's like a reverse mortgage. Every every year money's coming out. In this example, I've got $25,000 a year coming out to supplement pensions. And over time, we're actually going through the portfolio. Now, from time to time, what you need to do is go into the core portfolio and reconstitute the income wedge. So there are various ways that you can defend yourself against market volatility. One is time. Number two is diversification. Number three is getting precise on cash flow needs and using an income wedge, putting guarantees in place, and then from time to time, backfilling this income wedge strategy so you always have this safety net. Now, if you don't need the wedge strategy, if markets are going up, there's nothing wrong with averaging out of your portfolio and harvesting those gains to produce income. But when markets are going down, you want to turn off the tap and then go into the wedge strategy to produce income. Well, I hope you found this video presentation helpful. You know, if you are planning your retirement or if you are retired and your advisor hasn't talked to you about the income wedge strategy or strategies for defending you against market volatility, reach out to us. We'd love to start a conversation. It's shumphries@assante.com. 204-977-8049 is the phone number, and of course the website shaunhumphries.com. Anyway, wishing you all the best with your investment planning, your retirement income planning, and your financial peace of mind. You take care.